Hey everyone, and welcome back. In this advanced challenge, we are building on the project finance model we have built together from scratch in the previous course, how to pass a project finance modeling test. This time, we are taking things a step further, integrating the three core financial statements into your model: the cash flow statement, income statement, and balance sheet. Here's a quick look at the end result. A fully balanced set of statements linked into the existing model logic. We'll go through each modeling step together so you can see exactly how everything connects and how to build it yourself from scratch. If you would like to follow along, you can download both the revised case study PDF and the model start file for free. Just click the link in the description below and hit free preview on the course page. Let's start by looking at the updated case study together. I will highlight exactly what has changed in this version in comparison to the original case study from the previous course. Case study overview. You're evaluating an investment opportunity in the country of Solenta, a jurisdiction with a stable regulatory environment and active government support for renewable energy development. The project is a 150 megawatt peak utility scale solar PV plant that has already reached commercial operation and is fully constructed. The project has signed a 30-year fixed price power purchase agreement, PPA, selling 100% of its generated electricity at the busbar under a pay-as-produced structure. You're part of an infrastructure investment fund that requires a minimum equity IRR of 10%. So far, all of the given information is identical to our previous course. In a prior challenge, how to pass a project finance modeling test, you built a dynamic Excel model that included a well-structured pro forma cash flow. Now, your ask is to extend that model and integrate three core financial statements: the cash flow statement, income statement, and balance sheet. Objective. This challenge simulates a common follow-up question in real-world modeling tests. Recruiters often ask candidates to demonstrate their ability to integrate financial statements, a key skill for more advanced roles. Your goal is to integrate all three statements into the existing Excel model, ensure that the balance sheet balances at all times, reflect depreciation, interest, taxes, and retained earnings correctly, and maintain clarity, structure, and audibility throughout. Files provided. You've been provided with a model start file, the completed model from the original challenge, and a revised case study PDF, which is this document we are reading right now. The key assumptions remain unchanged from the original exercise and are provided again below for convenience. Okay, basically we can just skip over all key assumptions because we have already been reflecting those in our previous case study. Additional deliverables. In addition to the return metrics from the original model, your integrated version should accurately calculate and link all three financial statements, ensure the balance sheet balances, assets equals liabilities plus equity. So we are basically given a hint of the basic setup of a balance sheet here. And reflect changes in retained earnings, depreciation schedules, and financing flows dynamically. Now, before we dive into the modeling, just a quick heads up. As in the previous course, this walkthrough is fast-paced, designed to reflect the kind of pressure you would face in a real modeling test. I won't explain every single Excel formula or accounting concept in detail, but I will guide you through each modeling step so you can follow along from scratch. And if anything feels unclear, or you would like to dive deeper into theory, you will find more structured lessons in our courses at renewablesvaluationinstitute.com. All relevant links are in the description. And with that, let's jump into Excel. Alright, I just opened the start file, which is the final model that we've built together in the previous course. In the previous course, we have built this basic project finance model from scratch. If you haven't taken the previous course, feel free to check out the link in the description below. What we have done in the previous course is started with setting up our inputs time independent. We have also included one input which is time dependent, which was our SOFR forward curve. And then we have set up a pro forma cash flow model where we started with our model timeline and flags, inflation assumptions, generation, CapEx, revenue and OpEx, depreciation and unlevered taxes, which allowed us to calculate our unlevered pre-tax project IRR as well as our unlevered after-tax project IRR. The toughest part of the previous lesson was modeling our senior debt, including some sculpting according to a target DCR of 1.3. And then lastly, we were able to calculate our levered equity IRR, NPV, cash on cash yield, and payback period. Now in this case study, we will take it a bit further and now start modeling our fully integrated financial statements. And to do this, first thing we will do is do a right click down here on our calculation sheet and say move or copy. And we want to create a copy of this sheet in front of our calculation sheet. Hit OK. So we basically just replicated the same sheet. And what we do with this is we just use the basic setup of this sheet, so we don't have to start again setting up the basic structure of the sheet. And the only thing we will keep is our model timeline up here. We can delete our flags because we don't need our flags anymore. We will call this integrated financial statements. And the only thing we will keep is our model timeline. So you can mark row 7, mark everything what's underneath. And let's clear all these cells. So to do that, I hit Alt-H-E-A. Then also, while we have selected all of these rows, we can undo our grouping. So hit Shift-Alt left key. Great. Then for this one, we don't need to pull in any inputs. So we can actually tighten these columns here, maybe to a width of 1, which just gives us some more room to the right. Great. And first thing we will do is we will start with our cash flow statement. So jump into cell C8 and we will write cash flow statement. Actually, in parentheses, let's write CFS. Alt-H-J, that's a header 1 style. And first thing we will always have in our cash flow statement are our uses and sources of funds. So let's start with our uses of funds. We can underline this, Control U. And the only uses of funds we had, we can simply link this to our section up here, are our capital expenditures. I don't want to pick up total costs because it's not as clear. So let's just pick up the label here, capital expenditures. In more advanced models, you will of course have multiple uses of funds such as development costs, due diligence costs, financing costs. But in our case, we just have capital expenditures. Let's also rename our tab down here. Before we forget, let's name this fin_statements. And our unit will be in dollar again, in column E as per usual. Then we can also pick up a row total here. Control C, paste that here. And we can pull in our capital expenditures, which are here in row 27. So let's pick this up. Hit Alt-H-J, that's a (0) style. And now since those are uses of funds, so the SPV is paying someone these capital expenditures, this is actually cash outflow. So for the purpose of the cash flow statement, we will actually flip the sign to make sure this is negative. Drag this over, Control R. And this will give us our total uses of funds, also in dollar. Control D, and that's basically just the sum of this. Let's just set it up that way so it's a little more dynamic in case you would like to add further uses of funds further down the road. So now let's do some formatting. Let's grab that whole row here, bold it, and let's have a top border as well. Next up, our sources of funds. So where is the capital coming from to actually pay for our capital expenditures? Control U. And our sources of funds are equity and senior debt. In more advanced models, you might see a shareholder loan, but in this case, we only have equity and debt. And that will give us our total sources of funds. All of it will be given in dollars again. Let's pick up this row total here, paste it here. So let's start with pulling in our equity. That equals, our equity was at the bottom of the sheet. These are our equity contributions in row 104. So let's just pick up our equity contributions. Mark these 3 cells here, hit Alt HJ, that's a comma 0 style. And since these equity contributions flow into the SPV, we want to model them positive. So we don't need to flip our sign. And next we can pull in our senior debt. Our senior debt are our drawdowns that we have in row 92 right here, which is also already a positive sign, so that's fine. And the sum of these 2 rows will give us our total sources of funds. Now let's drag all of this over. And we can pick up the style from this row, copy this, hit Alt HVST to paste special formats. And once we have total uses and sources of funds, we can calculate our net cash flow after funding. Also in dollars. Let's pick up this row total here. That is going to be very simple. This is just our total uses of funds plus our total sources of funds. Drag that over. And we can mark the whole row here. Bold it. And have a top and bottom border. Now this is important. We always want our net cash flow after funding to equal 0, because otherwise that means that our total uses and sources of funds don't match. So either we have too much or too little capital to finance our capital expenditures. So this is a basic check to always make sure that the net cash flow after funding equals 0. And that also should equal 0 in every single period. So once we're done with sources and uses of funds, let's keep going with the revenue. Let's underline this one. And then we can pull in our label from our calculation sheet. We have our revenue further up here. And the only revenue which we have in this case is PPA revenue. Because we have a fully contracted utility scale solar PV park, which is contracted for the full asset lifetime with the off-taker. Let's model our total revenue anyway. Here as well, pick up the label. Both of this will be in dollars. Then we can pick up these 2 row totals here. And our PPA revenue is right here. Mark these 2 cells, hit Alt HJ, comma 0. And this is essentially just the sum of the above. In this case, just our PPA revenue. Drag this over, Control R. Pick up this style here. Copy this, Alt HVST. And that leaves us with our total revenue. So to reiterate, you can see that our project costs roughly $277 million. And over the 30-year asset lifetime, the project earns a total revenue of roughly $1 billion. So once we pull in our revenue, we can continue with our operational expenditures. underline this. And our OPEX sit right underneath our revenues in our calculation sheet. So let's link to this label here. Drag it down for 5 rows. All of this will be given in dollars again. Pick up some row totals. And then we can pick up our cost items again. Alt HJ, comma 0. And let's take the sum of this. Drag it over, Control R. And let's pick up the formatting up here. Great. Now you can see this is just a lot of linking to our existing data. But once we're done with all 3 statements, you will see it can be very helpful for decision makers to have all 3 statements sit together in one dedicated sheet to clearly see what does the cash flow statement look like, what does the income statement look like, and what does the balance sheet look like. And ultimately, the balance sheet is a great way of checking the model because our balance sheet needs to balance ultimately. And without properly linking your cash flow statement and income statement, there's no way of knowing whether your balance sheet will balance. Okay, with that being said, let's get going. So after our total OPEX, we'll have our operating cash flow, which is also referred to as EBITDA or EBITDA, which is earnings before interest, tax, depreciation, and amortization. That's given in dollars. Pick up a row total, paste it here. And now before we can actually link this together, we will have to flip the sign for our operational expenditures because these are SPV outflows. Let's flip the sign, copy this and paste special formula only to keep the formatting. Drag this over to the right, Control R. Now we actually have a cash outflow, which allows us to simply add up the total revenue plus our total OPEX right here. Drag this over. Pick up the same formatting as for the net cash flow after funding here. And before we get going, let's check whether the total EBITDA in this sheet matches our calculation here. And yes, it does. In row 40, we have the same result, so that's good. Then after EBITDA, I recommend pulling in taxes or taxes paid, which will then get us to cash flow available for debt service. Which is also referred to as CFATs. These are both given in dollars. Let's pull in a couple row totals. And for the taxes paid, now you need to be careful because in a previous case study, if you recall, we have modeled 2 different kinds of taxes. We have modeled our unlevered taxes, which were based on our unlevered project, meaning there was no senior debt underlying. But for our fully integrated financial statements, we will certainly want to include our financing, which means we need to pick up our levered taxes down here. Let's pick up this cell here and make sure you model them negative again. Hit minus. And a lot of students will ask now, why do we flip the sign? Because the taxes here are already negative. Now you can see that in the early periods, our taxes are negative. And in this case, that's actually cash inflow to the SPV because we will see in our income statement that in the early years, we generate such a high loss, which means that the government recognizes that we have incurred such a high loss in these early years that they're willing to pay us taxes back. Now you will rightfully argue that a lot of governments will actually not pay the SPV these negative taxes back but instead they would allow the SPV to carry these tax losses forward and offset them against gains or positive net income in future periods, which in our case would be the case in 2034. Now that would have required us to model a tax loss carried forward account, which we did not do because this is a very simple case study and we haven't been given any implications in our case study that we have to carry our tax losses forward. So for this simple modeling test, we will just flip the sign here, but be aware that this is a slight simplification for the purposes of this basic financial modeling test. Okay, now that we have flipped the sign, hit Alt-HJ and comma 0. Let's drag this over. And you can see that in total, we actually do pay quite some taxes, $103 million over the asset lifetime, most of which are paid in the later years, as you can see here. And that will leave us with our cash flow available for debt service. So we take our operating cash flow, add our taxes paid, which are modeled negative, drag that one over, and that will leave us with $750 million in cash flow available for debt service. Let's pick up this style up here, copy this, paste format special. Let's give this column some more room. And this leaves us with a $752 million in CFETs, which aligns with our result we got here. Okay, now that we have our CFETs, we can model our senior debt. So write senior debt, underline this, and we will have senior debt interest, and we will also have senior debt principal, which leaves us with total debt service. All of this will be given in dollars again. Pick up the row total, paste it 3 times here, and our senior debt interest and principal will be an outflow of the SPV again, so let's make sure we model it negative. Let's see where we have our interest expense. We modeled this one down here. Pick up K97, and since this is positive, we will flip the sign. Then we have our debt principal. That is already modeled negative in row 93. So let's pick it up right here. Hit enter. Then we take the sum of those two, which gives us our total debt service. Mark all of these cells, hit Alt-HJ, comma 0. Let's drag them over. And let's finally pick up this formatting here, Alt-HVST. Great. So we can see that out of $750 million CFETs, we will pay roughly or pretty much precisely half of it to the bank, which should leave us with almost the same amount of money available to our equity investor. So once we paid our bank, we will have free cash flow to equity, also referred to as FCFE, given in dollars. Pick up the row total here. And you guessed it, it's simply the sum of our CFETs plus our total debt service, which is already negative. Drag this over, Control R, and let's pick up the style from our CFETs. Alt-HVST, enter. Let's actually change the style of our total debt service to the same one as our total OPEX. Pick up this. This looks a little cleaner. Great. Now let's double check if this number aligns with what we had in our previous calculation. So 375 for free cash flow to equity. And this aligns with our dividends, because this is essentially what the equity investor will receive over the lifetime of the project. And here we have already netted it against our equity contributions, which in our case in the cash flow statements are already considered further above here. There we have our sources of funds which consider the initial equity investment already. So this FCFE is correct. Then next we have dividends, which are essentially just distributions to the equity investor. Given in dollar, pick up this row total here. And since the dividends flow out from the SPV to the equity investor, let's make sure we model them negative. They're right here in K103, flip the sign, minus Alt HJ, comma 0, drag it over, Control R. And that will leave us with net cash flow after dividends in dollars. And this is again just a check where we take our free cash flow to equity and add our negative dividends, and this should equal 0. It does. And what that essentially means is that we make sure that all the available cash flow to the equity investor is actually distributed to the investor and not stuck in the SPV in the form of cash. Pick up this style here, Alt HVST, enter. Some people might think that we are done now, but what's really important for our cash flow statement is that we reflect our cash account at the end, especially if you decide that in a given period you might not want to pay out full dividends, or whether you want to model a lockup that the bank triggers in a certain year. You want to make sure that your 3 statements are fully integrated, and that always includes a cash account. This cash account will also be essential for modeling our balance sheet. So write cash account, let's underline this. And we will have to implement quite a few accounts, especially for making sure that our balance sheet works as intended. And accounts always are set up in the same logic. In our case, we have cash brought forward at the top. Then we'll have a line item, we can call it change in cash. So these are always the cash movements, either in or outflows. And lastly, we'll have a cash carried forward. All of this will be given in dollars again. And as in our previous course, we always want to make sure that in this cell here, we have an empty cell style, because what we do in our cash brought forward is we refer to the previous period's cash carried forward. Hit enter, Alt HJ, comma 0. So we want to make sure that no one accidentally writes something in here like 1,000, because otherwise this will be picked up here. So we want to indicate that this cell here needs to stay empty. This will be the sum of our cash brought forward and change in cash in that given period. So how you can read this is the cash at the beginning of the period, and this is the cash at the end of the period. So if you look in 2026, the cash brought forward will reflect the cash amount in our accounts on the 1st of January 2026. And on here it will reflect the cash at a given moment in time, which is the 31st of December 2026. And for our change in cash, all we have to do is refer to our net cash flow after dividends. Then we can also pick up a row total for this one, just the middle row, the change in cash. And what you also always want to make sure is that our cash carried forward has an account balance style down here. Once you selected this, we can drag it over. And you can see that we don't build up any cash during any given year, because what we do is we take our free cash flow to equity and fully distribute it to our equity investor. But we can test whether the account works as intended. And we can say that in the year 2030, the equity investor might decide to only distribute $1 million, which would leave us with a net cash flow after dividends of $4.3 million, which is then built up in the cash account and would sit in there in perpetuity because we haven't adjusted a future dividend payout, which would allow this cash to be distributed. So let's undo this, hit Control R here to drag over the formula again. And what I like to do is implement a check. And we can say check negative cash balance. So I want to make sure that my cash balance never turns negative. We can also pick up a raw total here. And this is a simple if statement. If row K50 is smaller than 0, then we want our flag to turn on. Otherwise, it's 0. And then we can pick up a flag style from our different sheet here. Copy this, paste special only, Alt HVST, hit enter and drag it over, Control R. We can test it, check again. For instance, in the first period, we have 5 million available, but if we decide to distribute another $10, you could see that this would trigger a negative cash account, and that's obviously not good. So let's take that back out, and we know that our check works. Great, this is it for the cash flow statement, which is actually most of the work. So let's mark all of these, group them together. Let's do some further formatting, and we can mark all the rows that are space holders. Hit Control and mark them. All of these guys, and then we just narrow them maybe to a height of 6. That makes the cash flow statement overall much more readable. Great, next up we will take care of our income statement. Alt HJ, that's a header 1. And our income statement, let's always start with our total revenue. Then we have total OPEX, which again leaves us with our operating income or loss, which is our EBITDA. So those are all just kind of different names for EBITDA, but I want you to be aware that there are multiple ways of saying the same thing essentially. All of this is going to be given in dollars, Control D, pick up some row totals again. And now let's make our life easy. We already have all of these guys up here, so we can simply link that. Our total revenues up here. Our total OPEX are here. And this again is just the sum of revenue and OPEX. Drag it over, Control R. Pick up the style from our total debt service. Copy this. Alt HVST, paste special formats. And our EBITDA is the same again, but this is how we set up an income statement. So let's just follow the typical logic. Next up in the income statement, we have depreciation and amortization. So you might notice that this is different from what has happened in our cash flow statement, because in our cash flow statement, we, in the cash flow waterfall, first pay our operational expenditures, then thereafter taxes, and only when taxes are paid, we can pay our bank, which is why we first model our taxes and then our debt, which leaves us with free cash flow to equity. And obviously depreciation and amortization is not cash relevant, because what we do in the economic reality is we pay our capital expenditures of 277 million before we even start operations. But governments say, okay, you would incur a massive loss in that given period without any revenue to set it off against. So what we do instead is we depreciate that expense over a given period. In our case, it's 20 years. to lower your overall tax bill in a given period. So that's why after EBITDA, which is earnings before interest, tax, depreciation, and amortization, we first subtract depreciation and amortization. That will be given in dollars. Pick up a row total, copy, paste. And let's pull that in from our calculation sheet. And our depreciation is given in row 48, which is already negative, so that's great. Hit enter, Alt HJ, comma 0, drag this over, Control R. And you can see that we now spread the initial capital expenditures that we paid in our first year before operations throughout a period of 20 years evenly, which will offset our taxes we will have to pay in a given period. You might have guessed it, that will leave us with our EBIT, earnings before interest and tax. Let's keep going with our labeling. After we consider depreciation, we will consider senior debt interest. So that's only the interest expense because this is earnings before interest and tax, which will leave us with earnings before tax. Then we will have to pay taxes, which leaves us with net income. So for EBIT and EBT, let's pick up this formatting right here, copy this, paste it special here. We can click in this cell, hit F4 to redo the same. Pick up the row totals. All of this will be given in dollars. We'll need some more row totals here. And our EBIT is going to be our EBITDA plus our negative depreciation and amortization. Our senior debt interest, we have already modeled in our cash flow statement, so we can simply link it up here. And our earnings before tax will be our EBIT plus our negative interest here. And our taxes we also already modeled up here in row 33, which are also negative. Pick that up. That leaves us with net income, EBT plus our taxes. Let's drag all of this over. Let's see what happens. Control R. And you can see that we are left with $309 million net income. So certainly the project will be profitable. So depreciation and amortization reduces our overall EBITDA from 855 million to 577 million EBIT. And then further we have tax deductible interest expense, which reduces our overall taxable income further to $412 million, which is why for our levered case, we ultimately pay less taxes than for our unlevered case. In our unlevered case, we paid $144 million in taxes. But since we, in our levered case, use our financing to also consider tax deductible interest expense, we are left with a way lower tax bill of $103 million. Now for this one, let's pick up the free cash flow style up here, copy this, paste it special here. And you might think that we are done, but our case study told us that we should also consider and model retained earnings. And that's actually very essential for making sure that our balance sheet will balance later on. So to model our retained earnings, we start with our dividend distribution. After which we can calculate our retained earnings. Both of this will be given in dollars. Pick up a row total. Our dividend distribution is further up in the cash flow statement. Right here, link it here. And retained earnings are essentially our net income plus our dividend distribution. Let's drag this over, see what happens. Okay, we can see that we have 375 million dividend distributions and 65.6 million in retained earnings. Now, if you got a sharp eye, you will notice that this number here, the retained earnings number, over the full asset lifetime, which essentially just changes during our depreciation and financing tenor, this number here equals exactly our equity contribution. Now, why is that? Now, what happens is that the equity investor only receives back cash in the form of dividends. But from an accounting perspective, to offset the initial investment of 65.6 million equity contribution, we need to consider retained earnings and would expect indeed the retained earnings over the depreciation and financing tenor to match exactly our initial equity contribution. So that's a good sign, and what we will have to do also to be able to finish our balance sheet later on is model a retained earnings account. So write retained earnings account, underline this, and similar with our cash account, we will start with our retained earnings brought forward. And we will have retained earnings carried forward. And in the middle, we will write additions or subtractions. All of this will be given in dollars. And for an account, we only need a row total for the addition and subtraction section. Now let's do the basic account setup again. Alt HJ, that's an empty cell. We refer to this empty cell down here. Alt HJ, comma 0, Shift Alt equals for the sum total. Alt HJ, that's an account balance. And now this is easy for the addition and subtractions line item. We just simply link it to row 68. Drag it over, Control R. And you can see that our retained earnings start building up initially. They actually exceed the initial equity contribution. And then they plateau in perpetuity at the initial equity contribution. And that wraps up our income statement. So we can group all of this together. The retained earnings account will be essential for making sure our balance sheet balances after all. And then let's mark all the placeholders here. I'm holding down Control while I'm marking the rows. Let's narrow them to a height of 6. And we are done with the income statement. We can also actually name this in parentheses I/S. Hit enter. Now let's make sure that we actually save in between, so we can be sure that we're not losing our work. I'm just gonna name this three statement integration challenge final model. Hit enter. And now let's keep going with our balance sheet. So one last statement left. Balance sheet, also abbreviated as BS. Alt J, header 1. If we go back to our case study, they actually give us the basic balance sheet equation, which is assets equals liabilities plus equity. So let's set it up in that way. We start with assets, then we'll reflect our liabilities, and lastly our equity. So let's start with assets. Bold this. And accounting standard, we start with non-current assets. Underline this. And these are our capital expenditures, but I don't want to name them capital expenditures because on the balance sheet we would actually refer to such a thing actually as property, plant and equipment. Or also referred to as PP&E. And now again, this is a very basic case study. Usually we would of course have multiple non-current and current asset categories, which if you're interested, you can see what this would look like in our more advanced courses. But for this basic modeling test, we just have one kind of non-current assets and current assets. So our property, plant, and equipment will be given in dollars again. We don't need any row totals for the balance sheet, because the balance sheet actually just gives us account balances at the end of a given period. So it's a snapshot of the financial assets and liabilities of an SPV at a given moment in time, which is why we don't need any row totals, or actually the row totals would make no sense because they would just add up a bunch of account balances. Now that being said, let's go back to our calculation sheet. And what we see here in our depreciation category is that we don't even yet have an account for our property, plant, and equipment. So we will actually have to model this first so we can link it into our balance sheet. So what I'm going to do is add a bunch of new rows up here. So maybe give us some space here. And I'm going to name this accounting depreciation. Let's bold this. And let's name this property, plant, and equipment PP&E account. Underline this. And again, as per usual, we have a balance brought forward. Additions. Let's pick that up in 2 different rows. And in this case, depreciation and write-offs, depending how you refer to them, which leaves us with our balance carried forward. Now let's see if you can set up the basic account structure. Alt HJ, that's an empty cell. Here we refer to the previous balance carried forward. Alt HJ, comma 0, Shift Alt equals. That's an account balance style. Now for our additions, we will have to link in our total costs, which are modeled in row 27. Right here, this is our initial CapEx outflow, which then will sit in the account. And then this initial cost item will be depreciated over a period of 20 years. So we will link it to our depreciation expense, which is just an accounting expense in row 48. Drag this over to the right, see what happens. You can see at the end of 2025, where no depreciation has occurred, but we paid our solar park, which cost a total of 277 million capex. Then at the end of the first operational year, we have depreciated 13.8 million, which leaves us with an accounting balance left on our books of 263 million. And this is going to be reduced for a given period of 20 years useful life, at least for accounting standards, after which our solar park is fully depreciated. Then we can actually delete one of these rows here, group this together. And now we can link in our first account into our balance sheet. Now it's very important for the balance sheet that if you pick up accounts, always pick up the balance carried forward. So the end of period balance. We don't want to bring in the beginning of balance period, but the end of balance period, which in our case is row 63. So pick up 63 for this one. Alt HJ, comma 0. Then before we drag it over, let's keep going with our current assets. Underline this. And this will actually just be our cash. Also given in dollars. And now we have modeled our cash account further up here. And again, we link to our cash balance carried forward. So the end of cash balance. Great. And this will leave us with our total assets in dollars, which is just the sum of our non-current assets, PP&E, plus cash. Let's take all of these guys, drag them over, Control R. And you can see that our total assets decrease over time and then eventually hit 0. For the total assets, let's pick up our net income style up here to make it look a little better. Alt HVST, hit enter. And actually hit Control R here because we don't have a row total. And then we're good to continue with our liabilities. Bold this. And again, we just have one liability, which is our senior debt. In our more advanced courses, you will see a bunch of different liabilities. But for this case study, let's just focus on the basics. So that's senior debt. And that will give us total liabilities. Dollar and dollar. Now for our senior debt, again, we will have to pick up a balance carried forward. And that is modeled further down here. And our balance carried forward is given in row 101. So link it to this, hit enter, Alt HJ, 0. Total liabilities, we can link it again to this cell here because those are our only liabilities. Drag this over, Control R, and let's pick up the style from here. Great. Now that we have total assets and total liabilities, it's always nice to show that you know that the difference between total assets and total liabilities equal our net assets. And while I'm saying this, I noticed that we should probably model our senior debt negative because it's a liability. We want to make sure that it's displayed negative. So correct this here. And the sum of total liabilities and total assets will equal our net assets. So this equals total assets plus total liabilities. Drag it over, which will bring us to our net assets. Pick up the style here, copy this, Alt HVST, hit enter. And then you might have guessed it. What's left is the equity. And the equity consists of the initially provided share capital as well as our retained earnings account. So a lot of candidates get that wrong, but it's actually pretty straightforward once you've done it once or twice. And that will leave us with total equity. All of which is in dollars again. And we don't have a account for share capital yet down here in the equity section. But what we do have is our retained earnings account. So let's start with that. Our retained earnings account is up here. And make sure to link it to our retained earnings carried forward balance. Hit enter. Then total equity will equal the sum of share capital plus retained earnings. Alt HJ, 0, and we can drag this over, Control R. Let's pick up the style of net assets for our total equity. And we haven't yet modeled our share capital, so we wouldn't expect our balance sheet to balance yet. But let's nonetheless model our balance sheet check down here. This is going to be the ultimate test to see whether we have done a mistake along the way. And this will be a simple flag again. And our balance sheet check will be if our net assets minus our total equity equals 0. So let's put that actually in parentheses. If that equals 0, then we are fine. We want a 0, so no flag. Otherwise, we want a 1. We can pick up the flag style from up here. Copy this, Alt HVST, drag it over. And we can also pick up a row total. And you can see right now our balance sheet doesn't balance. Let's make it even more visible and implement a balance sheet check up here with a table header. And we can just pick up this row total, or we can say if this equals 0, then 0, otherwise 1. And from this sheet, we can pick up our check style. So copy this, hit Alt HVST, enter, and you can see we get a nice fail. And to see whether we actually get our balance sheet to balance, we will have to model our share capital account. So to do that, let's head over to our calculation sheet. And I suggest to do that at the very top of our equity section. So let's give this some room. Mark all these rows, hit Alt HEA to get rid of the formatting. And we will name this share capital account. Bold this. And you guessed it, this starts with a balance brought forward. Then we'll have drawdowns and a balance carry forward. Let's set up our basic account, copy the row total here, paste it here. Alt HJ, that's an empty cell. Refer to this one up here, Alt HJ, comma 0, Shift Alt equals. You can see if you take such a modeling test, you should really learn your shortcuts and get speedy with this kind of stuff, so you don't have to waste any time on setting up basic accounts. And our drawdown for our share capital account is essentially just our equity contribution down here. And in this case, we only have a one-time contribution, so we just link it to our contribution row, hit enter, drag it all the way over to the right. And you can see our share capital is raised once in the very first period and then just sits there in perpetuity. And that's what we expect. So let's group all of this together. And now we will have our moment of truth, because we will link in our share capital and see whether our balance sheet will balance. So let's link into the balance carried forward, hit enter, and you can see our balance sheet now balances in the very first period. So this minus this equals indeed 0. That's a great sign. Select the comma 0 style. And now let's drag it over. Before I drag it over, I would like to highlight that probably we will still get a fail in some periods, because in the previous case study, we have sized our debt with a iterative process, which means our debt is only rounded to a few decimals, and likely we will not have an exact 0 difference between the net assets and total equity. But let's see what happens. Hit Control R, and you can see our balance sheet actually balances in some periods, but not all of them. Let's check the check though. So you can see this number is essentially the same, but probably it's just some rounding issue. So what we do with our check is we say we round the difference of these two numbers. Let's actually add a parenthesis here. We round this to 0 decimals or digits. Hit enter, drag it over, Control R, and there we go. We get a positive sign for our balance sheet check. Our balance sheet balances, our total assets equal liabilities plus equity. And that's exactly what we would expect. So that's great. Also in different words, our net assets equal our total equity. So let's wrap this up with some basic formatting. Pick up all the fillers here or placeholders, tighten them, group all of this together, Shift Alt right. And we are done integrating our three statements. So in this lesson, we have integrated our cash flow statement, in which we take the perspective of what actual cash flows in the SPV look like, where do we earn our money, how do we source our funds through equity and debt, we pay our initial capex, then we earn PPA revenue, of which we have to use some to pay our operational expenditures, which leaves us with operating cash flow, from which we pay our taxes to arrive at CFETs, of which we subtract our debt interest and principal to ultimately arrive at our free cash flow to equity, which we pay out as dividends. Then we can actually do a little testing. So we can say that in one period, we might want to reduce our dividend payout. So we can say, look, in this period, we don't want to distribute any dividend. So let's delete this. And you can see we still get a balance sheet that works properly because we have integrated everything perfectly. So what happens is that this reduced dividend now flows into our cash account. It doesn't affect our income statement. It's a pure cash related issue. What it does though is it affects our retained earnings account, but it doesn't affect our net income. Just because we don't distribute our net income or dividends, that doesn't mean that we will have to pay more or less taxes. It's just keeps sitting in the account in that case. But our balance sheet still balances. And why is that? Because we have set up our cash account right here. So our current assets go up. Our liability side of things isn't affected. But what also happens is that our retained earnings account goes up as well. So look at the amount in retained earnings. Right now we have 21.8 million in that given period. So if we pull in our dividend again, hitting Control R here, you can see that our retained earnings account reduces again to minus 27 million instead of minus 22 million. So that's a great way of knowing that our three statements are fully integrated and work properly and are well connected. And this is exactly what the case study asked for. And if you practice this multiple times, you will become very efficient and fast at integrating the three statements into such a basic project finance model. And if you present the three statements in such a clean and neat way as we did right here, you will certainly impress your potential employer. All right, guys, that wraps up the three statement integration. And if you followed along and built all three statements from scratch, big congrats. This is one of those skills that really sets you apart in technical interviews. Most candidates can build a basic project finance model, but far fewer can actually link the income statement, cash flow statement, and balance sheet in a clean, reliable way. So if you made it this far, you're definitely ahead of the curve. If you want to download the completed version of the model, just head to the full course on renewablesvaluationinstitute.com. The link is in the video description. If you found this helpful, I would really appreciate if you left a like, dropped a comment, or shared it with someone else preparing for modeling interviews. It helps grow RVI's recognition and keeps me motivated to create more videos like this. Thanks again for watching, guys, and best of luck on your upcoming test.